Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Hello and welcome to LFI, LevFin Insights. My name is Kerstin Kubanek. I'm Senior Reporter at LevFin Insights. And with me today, ahead of the Deal Catalyst European Direct Lending Conference, is Dagmara Michalczuk, Co-Chief Investment Officer at Tetragon Credit Partners. Thank you for joining me today.
Thank you for having me. It's a pleasure.
Dagmara, how have CLOs started this year, and what have you observed in terms of spread direction and investor appetite?
So we have started the year initially with fairly modest spread compression at the top of the capital structure, but pretty good momentum. And over the last few weeks, that has reaccelerated, and we've seen some bigger moves at the top of the capital structure. The belly and the bottom of the stack remains incredibly well bid, and spreads are reaching post-financial crisis heights.
And how do you expect the CLO primary market to progress in 2026? And what split do you expect in terms of refinancings, resets, new issue activity?
So, of course, all of this is dependent on market conditions. So I will preface it with that. I think going into the year, the baseline expectation from the market and from us as well is that we'll continue to see a fairly robust refinancing and reset pipeline, given the outstanding vintages of 23, 24 that still need to right-size their capital structures to correct for the spread compression that we've seen on the loan side. On the new issue side, we expect fairly healthy activity again this year. I think the premise for that, the basis of that, is the activity that we saw last year, despite fairly choppy market conditions and challenging arbitrage. Particularly during the second half of last year, issuance continued to be dominated or driven by affiliated or captive capital, and that capital's continued to find the opportunity attractive, and I don't think anything materially has changed. Of course, the last 2 weeks have seen very meaningful new volatility in the market, particularly in the software space, and that's polluted some of the price action in the secondary market, which may make arbitrage slightly more attractive, provided, of course, that liabilities remain constructive.
And in terms of loan issuance, what did January bring? And is it enough to satisfy the CLO demand?
So January was a reasonably good start, but obviously everyone has very strong hopes for a true revival of M&A and LBOs. In 25, M&A and LBO activity was up about 9% in the U.S., which is progress, but it's still not running at the sort of average pace over the last decade. So everyone is certainly hoping that we will have more. The volatility that we were seeing in the market suggests that may be trickier than we expected just a few weeks ago. But nonetheless, some of the other factors, declining rates, positive regulatory regime in the U.S., more clarity on the macro picture, all those things should boost M&A in the coming year.
Thank you. And how does CLO equity arbitrage look, and what effect might this have on CLO issuance in the next few months?
So, as I said at the beginning, arbitrage is still challenging. It, of course, changes day to day as we look at where assets can be sourced relative to where liabilities are. What is very attractive is the tightness that we are seeing in mezzanine spreads, and the tightening that we're seeing that's more marginal at the top of the capital structure, but with an all-in cost of funds in the mid 140s, potentially going to 140, the liability side of the equation does begin to have long-term value. And of course, now where assets can be sourced below par and potentially lower, that might very quickly bring arbitrage in line. We found that over the last few years, those opportunities for very attractive locking in of both assets and liabilities can be quite fleeting, but we might see some very attractive pockets in the near term.
And how did January's wave of TLB repricings affect the CLO market?
So I think everyone's resigned themselves to the technical of spread compression, and all we can do is maintain, or all managers can do, is maintain credit quality and make those risk reward trade offs. I think the other side of the equation, compressing this year, or continuing to compress, is a positive, and the positive rational reaction of the market on the CLO side, where we still yet have not seen a pollution of spread widening from the recent loan volatility, I think is rational and constructive. So hopefully that holds, and the arbitrage becomes more sustainable and attractive again.
So you do expect more repricings to come then?
The base case expectation is that we have an extension of the credit cycle, with fundamentals on average being okay. Of course, there's tremendous dispersion and a lot of tail risk in the market, but I expect that with high quality companies, assuming the economy holds up, we'll see continued spread compression, yes, but not across the entire credit spectrum. So high quality companies that are well regarded, well sought after in the market, will continue to have an ability to reprice.
And what trends are you observing in loan portfolio quality and also trading prices, and which sectors are prompting concerns, and why, of course?
Yeah, so and maybe with the sector, starting with the sectors, I mentioned at the beginning that on average, fundamentals in the loan market have remained incredibly robust, particularly in the U.S., with a lot of resilience in the economy, which surprised everyone, year over year. But we do have a lot of microcycles in the market. Of course, the most topical one today is software, and that's largely driven by concerns around AI disruption, or this slowing of the attractiveness of the software business, so slower growth, lower valuations. The other industries that have been impacted by their own idiosyncratic issues are chemicals, of course, autos in the US, building products. In general, anything that is highly cyclical and affected by the K-shaped economy recovery in the US, so highly sensitive to the behavior of the lower two quartiles of income in the US. On the price action, obviously, we've seen the index this year lose about a point and a quarter so far. So on average, the index has moved down, and that's really driven by two things: the tail risk names in the market continuing to move down, but also some of the froth of above par names declining in that premium that exists. And so that's resulted in lower average purchase prices. It is still very much a market of the haves and the have-nots. So companies that are viewed as quote unquote strong, good quality, still have a very strong bid, and there's unfortunately an entire cohort that's finding a very difficult time to catch a strong bid.
And how is this translating into CLO performance?
So, of course, CLOs are not mark-to-market vehicles until the moment when value has to be realized. And so that is, of course, the end of life of a transaction, but also on an ongoing basis when the equity or the manager is looking to refinance or reset the transaction. So it's clearly net not a positive trend. However, these structures are built to weather technical dislocations, mark-to-market volatility, so long as the underlying businesses are performing, paying ongoing interest and principal repayment at the end. So the structure is built to withstand these types of events, but obviously the timing and the impact is very much dependent on where the CLO is in its life.
And do you see enhanced tiering between platforms either in Europe or in the US?
Yes, I think the market over time has become a lot more focused on market value coverage of specific tranches, and stability of that as a performance metric. And of course, given the leverage in these structures, there's a fairly wide dispersion. And so, yes, tiering has remained fairly persistent, and during periods of volatility like we're in today, it tends to expand.
And how are you positioning for the year ahead? Are you shifting up, down the CLO capital structure?
So we remain focused on the bottom of the capital structure, and mezz and equity in particular. I think our approach to the market has shifted over the last few years to become a lot more tactical and opportunistic. So we've really found that there are very few pockets of opportunity that are outstanding where you want to actually deploy in size and take advantage of either cheap assets or cheap financing, and then have the discipline to sort of wait out markets that are not as attractive. And that, of course, applies both to making new investments, but also exercising any optionality that we have as a controlling investor on refinancings or resets. So we tend to be incredibly active when the market is constructive, and wait for better opportunities when we don't see the value in the market.
And recently, we've seen quite a few new CLO managers entering the market here in Europe. Do you think that this trend will continue? And do you think that the hiring of CLO managers will gain momentum as well this year?
It's a very good question and difficult to answer. It feels like the momentum is there for folks to want to diversify geographically. So U.S. firms going into Europe and wanting to have a global platform. And although it's a very competitive and crowded market already, folks continue to believe that they can have a different view and a different angle on the asset class on the space and enter it. So I think all else being equal, yes, the momentum continues. And as an equity investor, I guess security investor in general, it does create a lot of risk and noise around manager selection, given that we are seeing so many folks moving across firms, which of course is a governance issue, ultimately, particularly at the bottom of the stack, where we might spend a lot of time and effort in diligencing a manager, picking a team, and seeing them move and switch, of course, is a headache and something that you have to think about as you're investing.
And are there any interesting trends that you are seeing in the market right now that we haven't touched yet?
So I think the other, of course, long-term trend is what is happening in the market with the restructuring pace, liability management exercises, all of the litigation around that, particularly in the US, but also in Europe. I think the US-Europe dynamic is also very fascinating. For a very long time, Europe folks had this view on Europe that would remain more polite, more rational, more collegial in its behavior. And it turns out that, of course, when things get difficult, folks are inclined to use every tool that they possibly can. So we are seeing LMEs in Europe. We are seeing some litigation as well. And so that on its own is very interesting. In the US, we've seen some very constructive, in our minds, litigation outcomes that are really discouraging of lender-on-lender violence and unfair, unequitable outcomes for pari passu lenders. However, we're also seeing some, litigation that is concerning potentially around Optimum's allegation that co-op groups are a form of antitrust behavior, so collusion. So it's a very, very important part of the market to watch if you're an investor at the bottom of the capital structure, because it will ultimately affect sponsor owner behavior and recoveries, which are critical to the sustainability and to the risk reward of the asset class.
Thank you very much. That's very interesting. Thank you for joining me today, and hope to speak soon.
Thank you.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.